Welcome, ladies and gentlemen, to Lesson 13, Reading Financial Statements, Trend Analysis and Financial Ratio Analysis, and also the Financial Reporting Conceptual Framework. Now that we've gone through all the other lessons, we know how to prepare a balance sheet, prepare an income statement, prepare a statement of retained earnings, prepare a statement of stockholders' equity, prepare a statement of cash flows. Now let's look at a real set of financial statements, not ones made up. HMS Roundbelly is a great tool for us to learn, but I've included in Lesson 13 an example of a real company's financial statements. Now, these financial statements are made open to the public. These are publicly filed documents. Remember when I said that the SEC, the United States Securities and Exchange Commission, it requires public companies to file quarterly and annual statements. Well, those statements are made available to the public so that investors can read those statements and know if they want to invest. So creditors can read those statements and know if they want to lend money. That information is available on the SEC's website. I've taken information for PepsiCo Inc. and I've included it here for purposes of going through today's Lesson 13. Now, but first, before we get into that, I want to go through the Financial Reporting Conceptual Framework. This is a big concept to grasp, but just know that every set of financial statements that's being prepared, it has to go through this Financial Reporting Conceptual Framework. You have to give consideration to each of these concepts within the framework to prepare a set of financial statements. We're going to go through the concepts, and you'll see they all kind of blend together, and they all kind of come together down here at the bottom of Lesson 13 cheat sheet. They all kind of come together in the financial statements, the elements of the financial statements. All right, so let's start at sort of the middle left here, the Financial Reporting Conceptual Framework. Reasons for the framework. Why do we have this framework? Well, we have the framework because we want to maintain consistency among standards. We want to resolve new accounting problems and provide user benefits. If we want to have a framework so that every company is reporting under the same sort of principles and policies, and you can compare company X to company Y, and you say, well, I don't want to invest in Pepsi, I want to invest in Coke because their financial statements look better. They're generating more cash. There's a potential more for them to give dividends to me if I invest in that company. So that's why we want to have a consistent framework for all reporting units, so we can make decisions based on the information included in those financial statements. Now, the objectives of financial reporting. The objectives of financial reporting are to provide information that is useful for decisions. Like I said, do we want to invest? Do we want to lend? Is management doing their job? Do we need to get rid of management? That's the thing of the board of directors or the directors are saying. Is management doing their job? Is management using the assets of the company wisely? Should we fire them? Well, that's useful information for decisions. Second thing, they help predict cash flows, right? Like I said, cash flow is important because if a company is taking in cash, there's a potential for them to give that cash back to their investors. If I invest in a company, I want something back. I want a return on my investment. That's why financial statements provide that information. They provide, they predict cash flows. If they're making money this year, they're probably going to make money next year. Third thing, they provide information about economic resources, claims to resources, and changes in resource claims. Okay, what does that mean? Economic resources. Well, those are assets. It's just a fancy word for assets, or a fancy way of saying it. Claims to resources. Accounts receivable, that's a claim to a future resource. Accounts payable, that's a claim to have to give up a future resource. That's all that's saying. So the financial statements provide that information. Claims to resources, information about current resources, and then changes in resources. Right? Look at our statement of cash flows. How did we come up with that? We looked at the changes in our assets, the changes in our liabilities, the changes in the company's resources. These statements provide that information. All right. Okay, so the qualitative characteristics of accounting information. Going back to Lesson 5, we briefly touched on some of the qualitative characteristics of financial reporting. We're going to revisit them here. The main thing is understandability or usefulness. In Lesson 5 we call it usefulness. Here we're calling it understandability, but it's the same thing, right? If I can't understand it, it's not useful, right? So it's the same concept. But underlying those concepts are relevance, reliability, comparability, and consistency. Information's got to be relevant. Remember, the notes of the financial statement, it provides relevant information about the numbers included in here. Also relevant information that's not included in these numbers here, the things I want to know, like a contingent liability. I would want to know if the company's being sued. If it's probable, but they don't know the number, or they don't know the amount, they disclose that in the financial statements. That's relevant information. Also, consistency amongst companies, comparability amongst companies, right? Do I invest in company X, or do I invest in company Y? Reliability, that's where the auditors come in. They say, are these financial statements in accordance with GAAP? GAAP, the generally accepted accounting principles, it's the umbrella under which all financial reports are prepared. That gets into sort of the usefulness. Also, the standards, reason for the framework, it maintains consistency among standards. Standards, that's we want to have reliable standards. We want to have a reliable set of financial statements that are in accordance with the standards. Now, go over to the right side, the bottom right, recognition and measurement concepts. These are part of the financial reporting conceptual framework. All right, each of these bullets, or each of these bolded, these are components of the conceptual framework, and each of those components has underlying concepts, right? So qualitative characteristics is a component. The underlying concept is understandability. Similar, recognition and measurement concept, the underlying that is assumptions. Economic entity, remember lesson 1, economic entity? The assumption is that these set of financial statements are only for this company, no other company, just one company. That's the economic entity assumption. It's just for one company. Going concern assumption, we haven't touched on this before, but the going concern assumption says that this company is going to continue in existence. If I invest in this company, I want to make sure it's going to be around next year so I can get a return on my investment, get my money back. Going concern says this company is going to be in existence for another year. That's an assumption. That we have to assume that this company is going to remain in existence. All right? Periodicity. That assumption is that we periodically report our financial information. Going back to lesson 1, the 5 W's of financial statements, one of the W's was when. When do we prepare financial statements? Periodically, right? Monthly, quarterly, annually. Periodicity says that these financial statements are reported for a certain period. The balance sheet is as a given date, the end of the period, and the income statement, statement of cash flow, statement of retained earnings, those are for the period, right? Periodicity. Monetary unit. This we haven't touched on, but monetary unit, it just says we need a constant monetary unit for these financial statements. Denominated in a US dollar. Well, okay, usually in American companies, they're denominated in US dollar. That's the monetary unit. We need to have a consistent monetary unit for the entire set of financial statements. In the example of PepsiCo and in the example of HMS Roundbelly, it was the US dollar. That's the monetary unit, US dollar. We need to have a consistent monetary unit. That's an assumption that we have to use when we're preparing financial statements. All right, principles. Historic cost principle. We've touched on that. Remember, everything we record at its cost, and we keep it at that historical cost. That's one of the principles. Realization. What is realization? Remember revenue? Going back to lesson 3, we talked about when do we recognize revenue? We recognize revenue when the sale, when we've provided the service, when the customer has received the goods and the collectability is reasonably assured. But realization of revenues, the recognition of revenues, it's the same concept. So realization equals recognition of revenue. Next one, matching. We all know the matching, right? We need to match revenues with the expenses. We need to have expenses be in the same period that are generated revenue. We need to match revenues with expenses. We need to match the period with the benefit. That's the matching principle. Full disclosure. Full disclosure makes sure that we have all the relevant information in these financial statements, whether it's in the statements or in the notes. All the relevant information is in there. That's full disclosure. We need everything in there. That's what a CPA does. That's what the accountants do. That's what the auditors do. They make sure all the information is in there. Full disclosure. That's that concept. All right. Now, when we're preparing financial statements, there's some practical constraints. There's some practical constraints to the financial reporting conceptual framework. Those constraints are cost effectiveness. What if it doesn't? What if it does? If it costs me too much to determine, how much my inventory, say. For example, I do a full physical count of all my inventory. Say I have millions and millions of products. Maybe it doesn't make sense to count every single one. Maybe it only makes sense to count a sample and determine that sample is representative of the population. Well, that's where cost effectiveness comes in. It says we're only going to do something, we're only going to research something, we're only going to present something in the financial statements that's cost effective. All right. So that's one of the constraints to financial reporting, is that we may not include all the information if it's not cost effective. Next, conservatism. Accountants are conservative, right? We're not fun. We're pretty dull. We're pretty boring. We live in this non-exotic, non-wild world of accounting, and conservative. We're conservative. We're not going to be too aggressive with our revenue. We're not going to be too aggressive with not recognizing expenses. We're going to be conservative. Yeah, put that expense in there because we probably got the benefit. No, don't recognize that revenue because customer probably didn't get it, or that receivable is probably not collectible. We're conservative. We don't want to be too aggressive. We don't want to show higher net income if it's questionable. We want to show the lower. We want to be more conservative. Conservatism goes into the financial statements. Materiality. Materiality is a concept. Pepsi. Look at this. All these amounts are millions of dollars. Millions of dollars. Current assets. It says 2,640, or sorry, 2,064, but that's 2,064 million. That's a lot of money, right? So they're not worried about $100, right? That's materiality. Pepsi wouldn't be worried about if they had petty cash in the corporate office for $1,000. They're not going to worry about counting that. They're not going to be worrying about making sure that exists when we're talking about financial reporting, because it's immaterial. It's not material to the 2 million that they have, right? Okay, that's materiality. It says these numbers are so big, we're not going to worry about the small numbers. We're only going to worry about the really big numbers. Now, all that information goes into the financial statements. Now, the elements of the financial statements, they need to be consistent, they need to be comparable. So all the financial statements are going to include these items: assets, liabilities, equity,